Hello, I'm Robert Knechel, a professor of auditing at the University of Florida in the U.S. and the University of Auckland in New Zealand. I also serve on the board of the Foundation for Audit Research in the Netherlands, and it's my pleasure to be able to moderate this session on assurance of state sustainability reports. We had a similar session in last year's conference that was pretty well received. Two of our panelists have agreed to come back for the second year, and we have two new individuals for different perspectives. Since last year, though, there have been numerous developments in the sustainability assurance space, which we'll be discussing today. First, let me introduce our esteemed panel, starting with the individuals who have returned. First would be Jacco Moison, who is the head of audit, financial reporting, and climate-related disclosures of the Financial Markets Authority in New Zealand. He also serves as the chair of the Emerging Regulators Group of the International Forum of Audit Regulators, or IFIR. Second, we have Imre Nagy, the Chief Executive Officer of the Independent Regulatory Board for Auditors of South Africa, or IRBA. He's also a board member of the International Forum of Independent Audit Regulators, IFIR again, and serves as the Vice Chair of the African Forum of Independent Audit and Accounting Regulators. He's also a member of the King Committee on Corporate Governance in South Africa. We have two new participants. First, we have Paul Munter, who until recently was the chief accountant at the Securities and Exchange Commission and has recently retired at the beginning of the year, I believe. And then we have Kristian, and I apologize for butchering your name, Koktvedgaard, head of the VAT, auditing, accounting, and reporting with the Confederation of Danish Industries, and a member of the EFRAG Sustainability Reporting Board. He's also chair of Business Europe Accounting Sounding Board and the Danish Accounting Council. So let me start by basically just asking you to give us a quick overview of what's been going on in your own jurisdictions, your own space, related to sustainability reporting and assurance over the last 12 months or so. So I think I'll start off with Kristian, since he brings a European Union perspective.
Yes, thank you very much, Robert, and thank you for having me. It's clearly been a busy year on the European side. We've seen the first reports being issued under the European Sustainability Reporting Standards, so-called Wave 1 reporters. But we've also seen increased legislation, a focus on burden reduction and focus of the entire sustainability reporting brief. There has been a proposal presented on the 26th of February by the Commission, and that is currently being negotiated both in the Council and European Parliament. And I suppose the key features of that proposal is first to change the scope of companies being covered by the reporting with an increase. The proposal talked about 1,000 employees. It is also a postponement of the so-called Wave 2 and Wave 3 reporters, so the ones not covered by the public interest yet will have a later reporting. More significantly, the mandate for sector standards is removed with the proposal, and also the change in auditing that will now, with the Commission proposal, be a limited assurance going forward. Hence, the mandate for reasonable assurance is going to be removed with the proposal. On the reporting side, the proposal asks EFRAG to provide a revised set of standards to reduce the amount of reporting requirements. I'm happy to say that we are going to launch a consultation on the 31st of July, running for 2 months. And currently we see a reduction in data points on more than 50%. The accurate percentages will be part of the consultation. And that is done while still keeping the focus on relevant reporting, keeping the principle of double materiality, and covering all the topics that was in the original CSRD. So quite a lot is happening at the moment, you could say. And I do think it has been a very interesting year so far, also learning from all the first reporters. And I must say, looking at them across, it's a high level of quality, but also a lot of pages, and probably too many pages looking at it in total. But the proposal is out there. the Council have reached an agreement, and we wait for the European Parliament, so we expect a political agreement between Parliament and Council sometime towards the end of the year. So I think that would be the brief overview.
Okay. So, Kristian, let me ask you a follow-up question. So, you just ended that by saying that you're waiting for Parliament. Just for those of us who are less familiar with how the EU works, once Parliament takes action, what does that mean at the national level?
The way the European politics works is that the Commission presents a proposal, the co-legislators, that is the Council and the Parliament, needs to find their own position internally, and then they need to reach an overall agreement. Once the overall agreement between Council, Commission, and European Parliament has been reached, and the proposal has been adopted, then it has to be implemented in local legislation. So the member states will have to change and/or implement in the respective member states. And as you're probably alluding to, some of the member states didn't implement the sort of first set of PSRD reporting. So we have a number of jurisdictions where we haven't seen reporting requirements so far.
So is there a timeline that's expected for this to finally be effective at the national level?
There is a timeline indeed in the directive. And I mean, it should have been implemented already in all EU member states. But for different reasons, there were a number of member states where that didn't happen. So it's the same as going to be seen with the revised set of the directive, so the overall mandate. And there's indeed also a timeline. And the expectation is it has to be implemented 2026, effective from financial year 2027. But that is with the caveat that Council and Parliament need to reach an agreement.
Okay. Thank you. Let's turn to Paul now. A while back, the SEC had a proposal, and what's going on now, if anything?
Well, first, Robert, thanks for having me join the panel. Very great pleasure to be with all the other panelists and talk about what's going on, and just a little more on kind of my background. As you mentioned, I was the chief accountant at the U.S. Securities and Exchange Commission for 4.5 years, give or take, which covered the period where the SEC was doing rulemaking with respect to climate reporting, and I was heavily involved in that process. That also gave me an opportunity to have a lot of engagement internationally because, among other things, the SEC is a member of the monitoring board, which oversees the IFRS Foundation. And so I was pretty heavily involved in the process that led to the standing up of the ISSB and the development of those standards. I also was privileged to be chairing the monitoring group, which is a collection of international regulatory bodies, including IFIAR, which is well represented here on this panel, which oversees the development of international audit and ethics standards, and so had a lot of involvement in that as well. But turning specifically to the SEC work, the acting chair of the SEC, Alison Aaron Lee, first started the process by kind of opening a comment file in early 2021, asking for input as to whether it would be useful for the SEC to embark on a path of rulemaking for climate reporting. If so, what should the commission think about, and the like. And the commission received, a fairly large number of comments just to that open comment file in the first half of 2021, many of which were supportive of the commission undertaking rulemaking, in large part because the landscape in the U.S. then and continues to be now one of a high degree of voluntary reporting. Almost all of the S&P 500 do some kind of sustainability reporting, including climate reporting on a voluntary basis. A high percentage of the Russell 2000 do reporting on a voluntary basis. So there's a large amount of voluntary reporting, but since it is voluntary, of course, two things come out of that. One is a lot of individuality. So real challenges in terms of comparability and consistency of what information is reported and the timing of when it is reported, oftentimes being, many months after the financial reporting process is completed. And then secondly, I'll call it the ownership of it, that you tend to have in a voluntary space, this kind of reporting being owned by portions of the organization that are not used to filings for SEC reporting purposes and the rigor and controls and the like that are typically required around SEC reporting. So that was, I think, a big learning of that initial comment file. And the commission, as you mentioned, Robert, is required to go through a notice and comment process. So a proposal was developed, and that includes cost-benefit analysis of the potential consequence of adopting what was proposed. In response to the proposal, which was first issued in March of 22, the commission received, I don't know what the final count was, but last numbers I saw was something along the order of 24,000 comment letters in response to the proposal. And, folks on the panel, of course, appreciate how large that is. But just to give you a perspective, the commission has been doing rulemaking for 90 years. And in the entire history of the commission's rulemaking, the second largest number of comment letters they have ever gotten to a proposal is something like 3,000. So to say that the response was overwhelming is an understatement. And of course, the responses, when you get that many, are all the way across the spectrum, with some highly supportive of it, others supportive but thinking the commission went too far, others supporting but thinking the commission didn't go far enough, and obviously others that are in opposition to it. And so the commission worked through that process and ultimately adopted a final rule in March of 2024, which then was challenged in the court system. And so the commission stayed the rule pending the litigation. In the meantime, of course, those of you that follow U.S. politics, you will know that we've had a change in administration that occurred in between. And so we have a different commission that is, has some different priorities and different perspectives on this. And so the commission just filed its response to the court literally last week as we're recording this. So late July. And that response essentially says, we're not really vigorously defending our rule. And so I think the short version is that it is, I would say, extremely unlikely the current commission would do anything that would require reporting of climate information beyond just the generic statement of, if it's material, then there are disclosure requirements under the federal securities laws. So I don't expect any rulemaking, either the existing rulemaking to take effect or some rulemaking to occur over the next 2 to 3 years as the current administration remains in place. But that being said, as I said earlier, there remains a high degree of voluntary reporting of climate information and other sustainability information. A lot of it is because companies want to be seen as good citizens. A lot of it is because investors are asking for the information, but a lot of it is driven by dynamics in other jurisdictions. Kristian was describing what's going on in Europe, and there are obviously a number of U.S. companies that either are or could be subject to reporting under ESRS and CSRD. There are other jurisdictions that are moving forward. prominently in Asia, but also in other parts of the world, including near to Imre and other parts of Africa, as well as in South America with Brazil going live, for example. And so a lot of U.S. companies are or may be subject to reporting in other jurisdictions, and so they're continuing to move forward. I guess I would describe it, from what I can tell, is U.S. companies are kind of continuing the journey they were already on, but are probably doing it a little more quietly than they were a year or two ago. But I do not detect that they have just put pencils down and stopped their process at this point, Robert.
Okay, well, that I was going to ask you about how much influence you thought other jurisdictions were having, because I suspect a lot of those companies have a footprint in Europe some way or another.
Yeah, and I think the sense I get as I engage with people is, companies, generally speaking, want to do the right thing, number one. Number two, they want to do it at the least costly undertaking possible as well, which is perfectly understandable. And so they are looking for ways that they can standardize around the globe throughout their operations to the extent that is available to them.
Okay. Well, thank you for that. A couple questions may come up later, but let me move on to Jacco in New Zealand. We're going to go to the Southern Hemisphere now. And Jacco, would you care to summarize what's going on down in your part of the world?
Thanks, Robert, and thanks for having me again on the panel. We are now in our second year of mandatory climate reporting in New Zealand, and a few things kicked in the second year as well. So we now have over part of our reports mandatory assurance as well. So that's the first time that's happening, and causing some challenges as well. Similar to Europe, we have a change in government, and with the change in government is also looking at this regime. So our government consulted on, again, the type of entities that should be reporting. And the consultation basically focused on two categories. One is it appropriate for managed investment schemes to do climate reporting? So that was the first question. And then the second one is, okay, the size of our listed market. Okay, what should the threshold be on reporting? And there were various options kind of offered to basically kind of lift up the threshold on when you have to report from about 60 million to either $500 to $1 billion threshold, which would reduce the population, I would say, by 80 or 90 entities from about 180 till almost half of it if all the proposals go to the highest level. So that would have quite a significant impact on the entities that are reporting. In the meantime, when other regimes have been set up, we are also doing quite some international engagement with the various regulators, as we kind of give everyone a free pass that for overseas entities that are listed on our stock exchange or otherwise caught by our regime. They didn't have to report in the first years, but we're now looking how we can adapt those regimes into our regime, that they can use their reporting in their own jurisdictions to satisfy the requirements here in New Zealand. So that are a couple of the developments that we're going through. And Robert, I'm pretty sure that you have some questions on the quality of the reporting and on what we have seen in the first years as well in the follow-up questions.
Well, one thing I'm curious about is, and you may not be able to speak well to it, but how is what New Zealand is doing compared to, say, Australia, since the economies are fairly integrated? The Australians had the luxury that there were standards available, so they went for the ISSB standards and picked those. So there are some differences in the standard perspective, and also they have quite a different way on how entities are captured. We focused on the financial markets. So you had the banks, the insurance companies, the listed entities, and they went on, similar to Europe, on size criteria. So it's just, okay, the size of the organization, how many staff members you have, how much revenue and how much assets you have. So it's kind of, it's slightly different approach to us. Standards-wise, it will be
reasonably similar. So yeah, we're now working through the differences and see how we can work together, because yeah, that's definitely the most important jurisdiction for us here in New Zealand.
So you set yourself up. How good is the information?
Yeah, it's kind of overall we thought it was good quality. There are a couple of challenges, I think, for entities. There are a lot of the data is quite general or industry focused, and I think people are struggling on how to translate that. Okay, what's the impact for my own company? So it's sometimes a bit on that too high level. The risks that they've seen are too generic, and sometimes they have 25 risks and opportunities where we think and say, hey, are those all material, or should there be a subset of those 25 that really kind of potentially impact the company going forward? So I think there is work to be done, but kind of for our first year, we were very satisfied with quality.
Good. Okay, so last but certainly not least, Imre, would you care to comment on what's going on in South Africa or Africa in general?
No, thank you very much, Robert, and thank you for the opportunity. And we really appreciate to be invited back. So in South Africa, sustainability reporting and assurance is not yet a legislative requirement. It remains voluntary. However, over the past 12 months or so, we have seen a significant movement towards legislative reform. And yes, I think we're leaning strongly towards ISSB, IFRS 1 and 2, and international assurance standards, because our mandate requires us to closely follow international standards, auditing standards, and ethics standards. But this sort of drive towards legislative reform is primarily driven through a number of regulators, including ourselves, the IRBA, regulating auditors. We have the Companies and Intellectual Property Commission, CIPC, and of course our main stock exchange, the Johannesburg Stock Exchange. But we do have a few smaller stock exchanges as well. And we are, as a group, collectively engaging to map out a roadmap for the adoption of sustainability reporting standards, and of course assurance thereon. Listed companies currently on the Johannesburg Stock Exchange are disclosing sustainability metrics in terms of guidelines issued by the stock exchange, which still voluntary, but there's a wide adoption of it. I think companies do recognize that we're moving in that direction, and voluntary adoption is the way to go. And they're even getting limited assurance on it, mostly limited assurance, and mostly appointing audit firms to perform the limited assurance. But we have seen some companies appointing non-audit firms. And we are warning them to say, look, you're doing it at your own peril, because some of those companies or service providers might not follow, this same level of standards as auditors would. So yes, but in South Africa, I think it's worthy to note that we expect to shortly table the IAASB's international standard on sustainability assurance 5000, and also the general requirements for sustainability assurance in terms of the international ethics standards code. We obviously take it through a local consultation process through our Committee for Auditing Standards and Committee for Auditing Ethics, or Auditor Ethics. So, but we do believe that within the next 6 months or so, we will see an adoption of these international standards. So what we're saying is, if you look at where we are compared to maybe New Zealand and the US, I would say there's 3 levels of adoption. One is there's some countries haven't moved or haven't really driven this process. And in Africa, there's quite a few of those countries that haven't come on board. Then you have those countries that are developing, that are in the process. And then you have advanced implementation, such as, I would say, in New Zealand and even in the European Union, they're way ahead of us. I would sort of put South Africa in the middle. We're in the process. We're developing standards. We're developing assurance frameworks, and companies are already adopting disclosure and assurance voluntarily. So we do see some movement, and we certainly will see more movement over the next couple of years as we try to legislate a framework on sustainability.
Thank you, Imre. Let me follow up on one thing you said, which is something I was going to touch on anyway. You said that some of these reports are being assured by non-chartered accountants. So some idea what kind of percentage of that is and who is doing it?
Yeah, interesting. That's a very good question. I've heard anecdotally, we haven't done a full analysis, but half of those that look, we have under 400 listed entities in the country. We're not a big country in that regard. So about half of the companies that do voluntarily disclose use the half of them use auditors, whereas the other half use non-auditors like engineers or boutique type entities providing this service, focusing on sustainability. The challenge that we have, though, is that we don't have a legislative framework in place. We can only regulate auditors that are registered with us. So if anybody else is appointed doing, offering these services, it falls beyond our remit as a regulator. So we actively go out there telling companies that, when you appoint a non-audit audit service provider to provide assurance, there is a risk there that they might not provide the service on the same basis as an auditor would from an ethical perspective. So that's why we're rushing towards, I wouldn't say rush, but we're expediting our efforts to get ISSA 5000 and the code part 5 of IRBA adopted in South Africa, because at least companies that appoint or the committees that then appoint these service providers can make it compulsory for them to follow ISSA 5000 and the code, which is very clear. You have to have a system of quality control in place. So we do think that the standards would bring that sort of control to mitigate the risk. But we're certainly not in a space where we want to be, but we're on the journey.
Thank you. Kristian, let me return to you and ask you to follow up on that as far as what you've observed in Europe or Denmark specifically.
In terms of assurance and not assurance providers, I assume. Yes, I mean, the European legislation gives a member state option to allow for other professionals than auditors to provide assurance. And we have seen in Denmark that they have opted for that solution, and draft legislation has been presented. And essentially, I mean, what you mentioned, Imre, the concerns about equal footing, level playing field, who's going to monitor. On the reporting as such, the individual report, as well as the individual assurer, so the person, that is going to be under the responsibility of the normal audit supervisory authority, with the same mandate, same level of fines, same disciplinary tribunal, etc. On the company side, however, since in Europe there is a overall legislation as well covering those sort of other providers that provide certification services, that this is perceived to be part of. There's a different EU legislation in place. So essentially that authority will have to take care of the company side. And at least what we observed in the Danish legislation is there's that little element that actually the certification or independent assurance provider, they risk losing the license. Where the audit firm doesn't stand to risk losing the license, they will just be heavily fined. So essentially you could say that it's actually tougher to be a certification service or independent assurance provider on these issues. But what we've done is we've mirrored the legislation as far as we could, but then we also recognize there are differences that needs to be observed, and that is especially on the company side or the entity-wide side of the assurance providers. on the individuals, it's easier to bring them at equal footing. I assume on the opinion side, there will be a draft or proposal for what the opinion should look like. But I suppose a key element is we actually have a tradition in Denmark to refer to the IRBA Code of Ethics, or at least the IRBA Independence, where in quite a number of jurisdictions, you just refer to the ethical requirements of your country. So I could argue there's already an issue about transparency in terms of what you refer to. This may make it worse, but I think it's probably also a chance for trying to figure out what do we actually want to refer to internationally. Should it be the IRBA Code or something similar, so we have at least that level of transparency, just to sort of kick it back.
Okay, thank you. Paul, given the proposal that was floating from the SEC, would you have expected that there'd be anybody other than CPAs in the United States who would be giving these opinions?
Well, so the SEC, the rule that, as I said, is stayed, does have assurance requirements in it. It does require that an assurance provider provide assurance started at limited assurance, and then for some issuers, the largest issuers, ratcheting up to reasonable assurance at a later point in time over Scope 1 and Scope 2 emissions information, which, of course, would be reported in accordance with the Greenhouse Gas Protocol. I guess I should anecdotally mention that I'm now a member of the Independent Standards Board of the Greenhouse Gas Protocol, so I've gotten myself pretty heavily involved in that as well lately. But anyway, all of that, of course, is on hold along with the rest of the SEC rule. But the survey information that I have seen, I haven't done the survey, but I've seen survey information from both IFAC and the AICPA indicates that, somewhere near 50% of sustainability reports do have some level of assurance on them. But it is at this point more being provided by non-CPA firms than by CPA firms, number one. And number two, in a large number of cases, and this gets back, I think, to one of the points that Imre was making, is in a large number of the cases, it's really hard to try to figure out exactly what level of assurance is being provided when you read the report. So it's a lot of confusion. So the SEC gave that a lot of thought and obviously got a lot of input on that, and decided not to restrict it just to audit firms. Now, bear in mind that the SEC's rulemaking involves cost-benefit assessments. And if you take as the state of play being a large number of assurance engagements are provided by non-CPA firms, then the cost of moving to assurance is lower if you allow those non-CPA firms to continue to provide that service. But you do have, and I think Kristian was touching on this, the risk of an unlevel playing field and what amounts to an unlevel quality of assurance being provided, which is not helpful for investors in the respective companies. So that's some of the things that the commission had thought through in that regard. I will say that there were comment letters in the file, and all 24,000 of them are publicly available if you want to go peruse through them. But there were comments in the comment file that asked the question about whether providing assurance was the practice of accountancy. And therefore, if the answer is yes, the follow-on question would be, well, would non-CPA firms providing that be, in effect, practicing accountancy without a license to do so? Now, that's a legal question, so I don't know the answer to that question, but that is part of the landscape that is at play here. Obviously, organizations like the AICPA would argue for it being limited to CPA firms. I do think as a practical matter, to answer your question, Robert, and I'm just speculating here, but if I were to put myself in the role of being an audit committee member on an SEC registrant, I think I would be very reluctant to engage somebody other than my audit firm to do this. And so my guess is that in the U.S. marketplace, even if there is permission for other service providers, that practice is likely to end up being heavily dominated by the audit service provider, at least for SEC registrants. That may not be the case for other companies, but that would be my speculation. I also should note the point that Imre made about oversight. We spent a lot of time thinking about and came to the conclusion, just like Imre described, that there is no legislation that allows for oversight of organizations other than firms that audit the financial statements of listed companies. And so if other service providers are engaged, there is the question of, are they subject to oversight? If so, what does that oversight look like? What's the quality and effectiveness of the oversight? And so that's also a bit of a potential for differential playing field that could come out of the process in the U.S.
Okay. Yeah, Jacco, let me come back to you for quickly. So what's going on in New Zealand? I mean, do you have mixed providers? What kind of standards are they using? And more specifically, we've been talking about sustainability reporting in general, but the couple examples I've heard mentioned are actually greenhouse gas emissions. So are we really talking about just greenhouse gas emissions, or is there actually a bigger set of information that's being covered by some of these engagements?
Our requirements is over greenhouse gas emissions, the mandatory assurance for this year, and that's not going to change either. We have delayed a little bit of the greenhouse gas scope 3 emissions, although we see some voluntary assurance on that as well in this year. We allow for both audit firms and non-audit firms to do these engagements. Our market is very small, so I would say 99% of all the engagements are done either by the Big Four or one non-assurance practitioner. We have addressed, I think, the requirements of the standards. They have to comply with the standards set by our standard setter, regardless if you're an audit firm or a non-audit firm. At the moment, we have a temporary standard because, again, the standard was not ready when people wanted to use it. So what we've done is you can both use the greenhouse gas standard 3410 or the ISO standard, and then we have an overarching standards that deal with things like independence, but also the quality control systems. It is derived from the Ethics Standards Board, but we're now going through the process from a standard setter point of view. Okay, are we going to adopt the international standard ISO 5000, which is likely to happen in some shape or form, and that brings us back to us as a regulator. There's just one requirement of the law is you have to comply with the standards set by the standard setter. So we will have a mandate both over audit firms and non-audit firms. We're early in, but I wouldn't say that one is better than the other. I think they're all making mistakes at the moment. So we're having discussions with almost all practitioners about some level of misunderstanding of the standards. And I agree with Paul's comment. Because a lot of entities go beyond the requirement of just assurance over the greenhouse gas requirements, it's sometimes very difficult to read those assurance reports because, it's all over the place. It's limited versus reasonable assurance, over quite a lot of different aspects of the climate report, but not the whole climate report. So I think the explanation table is sometimes a page long to explain what has been assured. So I'm not sure if that is very useful for readers. Even for me as what I call a expert, it's difficult to read. I don't have the vision that people that just look at the opinion and see an opinion that they understand what is really assured. So I think there is a room for improvement there.
Okay, thank you. Kristian, actually, I've heard the word independence thrown around a couple times with a couple of our responses here. I remember, and this may be a moot point, maybe this is a subtle question, but a couple of years ago when we first started doing these kind of conference, there was discussion about whether the auditor of the financial statements could actually do the audit of the sustainability report, meaning is that a non-audit service or is it actually an assurance service? And I was wondering, has that been settled, do you think, that question?
I think it has been settled, at least in Europe. I mean, it's clearly an assurance service, so you can do both. So I think from that perspective, at least from a European perspective, we have decided that assurance on sustainability is an assurance service similar to everything else. And I mean, that goes both for mandatory and voluntary assurance work. And there's also a great need for the voluntary side. But I suppose on the independent side, what is important to understand is that since it's an assurance service, you should also look similar to the independence requirements. And I mean, you can start by mirroring simply what does it take to be independent from a financial side. And then there are all the peculiarities in terms of what you see on the sustainability side. I would probably focus on only two of those elements. And one of them, you could argue, is probably not independence. But if you look on the value chain information, there are clearly some dilemmas there. You can have a very pure look at it and say you cannot audit anyone in the value chain because then there's a risk of you not being independent. And I mean, if you do that, then probably only 4 companies in the world can get an assurance opinion. Because the rest will then be subject to some form or shape of being part of the value chain. So I think it's important to have a practical view on this. Probably a little bit like you do on a large debtor that you are also auditing and you know the debtor might not be able to pay. How do you deal with that today in your financial statements? That's probably the dilemmas you need to be inspired on how to look into the value chain discussions, because some of the value chain, and I think that's really the key issue here, is that the value chain plays a so much stronger role here. So you need to understand that. There's, of course, a DMA. You cannot provide a DMA analysis. You may be able to provide a tool, but you cannot take decisions on behalf of a client. The DMA, at least in Europe, is essential for how the report will look like. So if you is not independent on that, then there's clearly an issue. And the other aspect, a little bit linked to independence, but more linked also to ethics, is the reputational risk. And I do think a lot of professionals need to understand that knowledge actually is really, really important when doing sustainability assurance. If you do not understand the risks, you will have the risk of running blind. So you may very well sign something where you don't understand the risks. And I think that is something that you really, really need to understand if you are a financial auditor and would like to get into sustainability. You need to get the right people around you to be sure that your team understands that. So I think that would be my two overall issues. I mean, clearly it's an assurance engagement that's been decided, at least from the European side, on legislation, and hence all the similar rules applies, and more stringent if you apply.
Okay, before I go to somebody else, I'd just like to add to that because I wrote something in the journal, I think a year ago, that basically I looked at 4 attributes that the chartered accountant or CPA brings to the table for these types of engagements. One of which I think we actually underappreciate a lot, which is we have our core expertise is in verification. And I don't think there's any other profession that has that expertise developed to the level that we are used to doing that. And the ability to look at large sets of information, large organizations, large risks and sets of risks and controls, and verify if the information is reliable. I think that's a big plus for us. The second is we have a culture of quality control systems in place, which I think also gives the accounting profession an advantage. And then the one that we're just talking about, which is the fact that we have such a well-developed infrastructure for independence, which I don't think exists in any other profession at this point, also gives us a big advantage potentially as auditors. The one thing that we could arguably be weaker on is subject matter expertise. But as you just said, knowledge matters. And so to the extent that actually generating or obtaining that knowledge and that expertise may in fact be more easily done than any of the other three attributes, because of the nature of that knowledge is very transportable across people. So, Jacco or Imre, would you want to add anything about this discussion about independence from your perspectives?
So really, I think I agree with what you just said, Robert, in terms of what auditors bring. Also, if you look at bringing on it to another discussion of attractiveness, I think those are the things that youngsters need to hear, drawing them to the profession. But the concept of independence, I can just comment there, independence in sustainability is really converging rapidly with the stringent requirements of that's applied in financial audits. We do see that and we understand that and the reason for that. So when an audit firm conducts a sustainability assurance service, it should be unequivocally considered as an assurance or audit service. Kristian mentioned that. It doesn't matter if it's limited or reasonable assurance. It's the principle that's at stake here. So while the level of assurance impacts the nature and extent of the procedures performed, it does not alter the fundamental independence assurance function. So the problem that I personally have is the one-stop shop risk. That's where you have some of these boutique service providers. They compile the report and they issue the audit opinion. That's in direct breach. There's a clear self-review threat there. And I think audit committees should play a much bigger role in making sure when they appoint these service providers, even auditors, that they're not involved in preparation and they're not marking their own homework. That's just a fundamental issue. And that's why we think that ISSA 5000 will definitely bring that profession agnostic approach, as mentioned earlier. But it requires these service providers, whether you're an audit service provider or not, to apply the provisions of the ISO code, Part 5 in particular. And ISSA 5000 says that any practitioner that performs an engagement should be a member of the firm that is subject to ISQM1. I mean, these are fundamental principles. So I think if I'm in the shoes of an audit committee member and I'm appointing either an auditor or non-auditor, I need to make this a clear requirement to say you must apply the international standards and the code of conduct in doing your business. But you see the big risk is now, do these other entities have, for example, EQR? Do they have those processes in place? Which I doubt. So I agree with Paul wholeheartedly that I think that auditors are best placed to do this work. And because the standards also, it's being beefed up now, in terms of the use of an expert. So the structure is there for auditors to provide the service, and they can rope in the skills if they don't have it in-house. But it will be backed on your 4 pillars that you just mentioned, Robert, that what auditors bring. So it's for me nonsensical that traditional auditors are the best service providers to go as a go-to place.
Okay, so let's talk about governance here for a second then, since you mentioned the audit committee. Paul, let me throw this kind of speculative question out. Under Sarbanes-Oxley, audit committees have certain responsibilities related to financial reporting. Was it discussed in that proposal to extend those responsibilities to the sustainability reporting also? I mean, what is the responsibility of the audit committee in that kind of setting?
Yeah, it was certainly discussed in the proposal. At the end, in the final rule, there was no explicit requirement. However, there's a couple of aspects to it. One is the final rule, kind of coming back to Imre's point, does require the assurance provider to be independent in accordance with SEC independence rules, regardless of whether it's an audit firm or not, for all of the reasons that Imre and Kristian laid out there. Secondly is in SEC issuers are required to disclose each year what the fees are they paid to their audit firm, broken into 4 buckets, one being for audit services, second being for audit-related services, third being for tax services, and fourth being other. And the final rule says that if you have assurance over sustainability information, then that goes in the audit-related category using SEC parlance, which I think is consistent with the points that Kristian was making earlier, which then, to your point, Robert, almost begs the question of, all right, while the SEC rule doesn't specifically mandate that the audit committee engage the assurance provider over climate information, since that information is going to then get captured in the SEC filing in your 10K, and who you've engaged and the quality of that service provider and the like, from a governance perspective, and similar to, I think, what the point Imre was making, if I'm sitting on an audit committee, I'm going to demand that we have that responsibility because of the transparency that's required around it, and the fact that becomes an integral part of your corporate reporting package, over which the audit committee does have responsibility.
Okay. Kristian, governance structures can be quite different in Europe compared to what we see in the U.S., supervisory boards, executive boards, and so on. Where do you observe that responsibility lays in a typical European organization? And is the board at some level setting up subcommittees to deal with climate reporting?
In one instance, it's probably a fairly easy question because the European legislation requires the audit committee or a similar committee to take responsibility. It's simply part of the directive. And since it's part of the mandatory element of the annual report, that I think flows very well. It also then answers part of the question, namely that the board ultimately is responsible since it is part of the annual report and they have the overall responsibility. We do see also companies outside the mandatory requirements either setting up committees or at least taking it part of the board role to also look into the assurance or the sustainability reporting and the assurance on that, as they do for the financial. So I think it has fairly equal footing. Just one element on the independent assurance providers that I just think is important is that we tend to focus on the last listed. There's a huge market for the voluntary smaller reports, where I do see that there's also a significant importance of them having access to assurance in some form or shape. So just to make that diversion. But back to your question here, we have a mandatory requirement. It is part of the boards, and I can see that they take that very seriously, as seriously as they do with the financial.
Okay. Jacco, you have anything to add to that? And from the New Zealand perspective?
Yeah, kind of our legislation follows kind of the similar rules for financial reporting. So it's kind of directors are responsible for the climate statements and are responsible for making sure that they appoint an assurance provider and get assurance over that. Maybe quickly back on independence, because we have a level playing field, they have to apply the same standards. So we don't really have an issue with kind of that we think that auditors are better than accountants. I think we have to be very careful to say that as well, because 10 years ago I saw auditors kind of preparing financial statements and auditing them. So I think it's a journey. I think we've all been very harsh as regulators to tell them off. But yeah, if you see what happened with our neighbors not that long ago about confidential information, I think there's still level for improvement. So I won't dismiss other people that if you have the same rule book, that you can apply those rules appropriately as well. So a bit of a defense of other assurance providers, which, by the way, most of them have a CPA background anyway, so they have to comply with the ethics codes, full stop. So.
Okay. Imre, just a slight change of topic before we end up with, we only have a few minutes left. Based on what you've seen, what is being assured besides climate information and greenhouse gas emissions? Do you have any knowledge or examples of things being assured beyond that?
So Robert, yes, because it's voluntary, it varies. Our stock exchange, Johannesburg Stock Exchange, issued guidance and guidelines in terms of, how to report and what to report on. So it's certainly not restricted just to greenhouse or climate. We see reporting across ESG. The few that I've looked at, and it's not an area that I'm very much monitoring at that level, at the technical level, but from the few reports that I've seen, there are elements around governance, there's elements around social and environmental. So it's not heavily focused on climate, for example, such as in New Zealand. And like I say, it varies across entities. If you don't have a framework in place, it's very difficult to sort of get any sort of consistency or to do a comparative analysis. So at this stage, I think a lot of companies, especially subsidiaries that are affiliated with global companies, they do take the cue from the global companies, in terms of what to disclose. So I think those companies are more structured. For example, those that are listed with primary listings in the UK and in Europe. So those we do see they comply with the requirements at that level. But consistency is certainly not there, but the level of assurance that we've seen sticks around the limited assurance at this stage. We don't see. I think I'm yet to still see a reasonable assurance, but I heard there was one recently. So it's really early days for us. And to Jacco's point, yes, we're on a journey, and we're certainly not. We're still on the runway here.
Okay. Well, we're almost out of time, so I'll give each of you a chance to make any final comments. I'll just start with you, Imre, if you don't mind. I'll go reverse order from where we started. So any final comments or thoughts?
Okay. Yeah. Well, thank you very much. I think we will see, over the next few years in South Africa that sustainability reporting and assurance thereon will become an integral mandatory component of corporate reporting. I think that's inevitable, driven by the global regulatory alignment. Companies have cross-border operations and reporting requirements that need to be taken into consideration. So I do believe that the standard setters, I think we should commend the standard setters for being proactive in this regard, bringing us code, bringing us sustainability assurance standards that can be adopted. And I certainly believe from an African perspective, if I talk to our neighbors here in Africa, a lot of them are leaning towards ISSB, IFRS S1 and S2, with, let's say, a lead time in terms of after adoption. They will, for example, have a period of voluntary adoption or a transitional provision. But yeah, we certainly see that. And then in assurance, aligning it to the international standards setters assurance, I think covers most of the risk, and it will bring that consistency. And we certainly are excited to be part of this over the next couple of years to see it taking off.
Okay, thank you. Jacco, 60 seconds or less. Anything to add?
Yeah, definitely international alignment, but also having a fair discussion on what is the value of the reporting, because there's so much reporting at the moment. Is it all valuable information for the user? So if we have that discussion on bringing back, okay, what's the real valuable information to be disclosed, and can we get international alignment so that it is comparable, as Paul mentioned in his beginning opening statement.
Okay, thank you. Paul?
Yeah, I think the point that Jacco and Imre made are really good ones, that this is a journey and it will unfold over a period of time. I do say, at least from my experience, that the international regulatory community is very willing to engage with one another, to learn from one another's experiences and have views shaped by that, with a goal towards trying to get to a spot while each jurisdiction is perhaps in a different step on that journey, but trying to get as aligned as possible from a standard setting and a regulatory perspective as possible, given the restrictions that we each have in our jurisdictions, which should enhance the quality of the information that is provided and the usefulness of it to investors.
Okay. Kristian, last but certainly not least, anything to add?
Thank you very much. I mean, we are definitely looking into an exciting autumn with political decisions. So what I've spoken on so far can change if the political decisions change. However, I am positive in terms of where we're headed. I will assume and hope that we will see a more focused reporting, still with the same coverage, still supporting the Green Deal and the transition. We will see practice develop, for sure. We will see, I hope, more focus on decision usefulness, and I think that was what Jacco also talked about. I mean, it needs to be relevant, and we need to go through the same exercise we've done with financial reporting, where it was also becoming very voluminous and then being reduced and more focused. We will have to focus reporting, definitely. And also, hopefully, and that will be the final straw, also that will lead to a more global standardization, or at least interoperability globally. I think that will also be helpful, and that's definitely something we're working on also from the European side.
Thank you, Kristian. I think what I hear across all four comments is that international alignment is well underway. It's a journey. It may have slowed down a little bit in the last year, but I think that's more reflective of the fact this is actually hard. We started this path with the idea that we wanted, that globally this was a good idea, and then we began to realize that it was actually not a trivial problem. It's a hard problem to solve. So I appreciate very much you taking the time to participate in this panel. Thank you very much. You made my job as moderator very, very easy. So on that note, we're going to close this conversation, and thank you for your help.